So how many of you have made this statement in your trading career? They know where my stops are. Right? They. As if the market's ganging up on you and trapping you into these silly little trades. Well, unfortunately, they do, sort of. I want to walk you through something we call the Group C syndrome. Okay? I don't want to bore you, but it's a simple illustration that will help you understand a little bit of market psychology and hopefully change the way you think about trading. So focus on the little white lines, and I'll be happy to answer your questions at the end of the presentation. All right, so after moving lower, the market finds this, point of support. Okay, now rather than speculate as to the cause of this specific support level, right, let's try to focus on just the buy-side participants and how their actions affect the market moving forward. Okay, in this case, we'll concede that buyers engaged the market at a price they felt was cheap, and they pushed the price higher. Okay. Now, from an order flow perspective, if this is going to trend higher, my experience tells me that very few traders actually participate in the early stages of a move. Okay. It's usually led by a small group willing to risk the turning points to, pick the low of a swing. Most traders are waiting on indicators or something to identify the trend. They generally do not pick lows. But those who do, eventually they're going to realize a profit. Right? They sell out of their longs. This can be either with a limit target, creating some market depth up there, or with a market sell order hitting the bid price. Either of those are going to have the potential to create some temporary resistance, driving the market back lower. Okay. Now, at some point, we're going to retrace enough here to entice a larger group of participants to buy at a better price. This is essentially the pros and institutions that you call they. All right. Now, I'm not going to pretend that this is some magic pattern or signal for institutional traders, but the order flow is generally going to show considerably more participants in this move than in the initial move. Now, I want to be clear, we flag this as the pros because where the trading takes place generally calls for larger risk requirements. Right? Most retail traders are trying to put stops below the last lows, which at this point could probably be substantial. Right? An institution hedging or a pro working a spread, well, they're aimed at blanketing the area. Right? Knowing that tight stops are just going to be hammered. But they understand the potential for momentum higher is definitely presenting itself. Their buying forces the market higher, and just like Group A before them, Group B is now going to realize a profit. Okay, so at this point we actually have the makings of a visible trend line. This is exciting, right? We can now see something clearly on the chart. It's screaming to us, the trend is my friend, the trend is my friend. Okay, enter Group C. This is the largest group and the most predictable. Small retail traders. They've missed the whole move from the bottom, and they finally see proof, confirmation, a level, something to make them feel warm and fuzzy. Largest, latest, and most predictable. They've taken the bait. Okay? Instead of holding, the market breaks down across the visible trend line. And while there may be some traders willing to hold on, you know the feeling. If it'll just move back up to my entry, I'll get out now and I'll never buy this thing again, please, please. So some will survive, but most won't. It'll magically go down exactly to their stops. See, the longs that Group C held, they're going to come out of the market as sell orders. That's how you exit a long, right? You sell. Generally, when you're stopped, you're going to sell into the bid. But Group C's failed to recognize the significance of the price. Okay? Having been a prior breakout level, this lower price is going to intrigue another group of buyers. In fact, this is only a little bit higher than where Group B bought it last time. And they were able to book a pretty tidy profit on the trade. So Group B buys again. Okay. Now, come on, guys, not necessarily the same traders, but traders with the same mentality. You see, if a substantial number of buyers are bidding in this area, they're virtually guaranteed to be filled by the sell orders flying in from Group C's stop-outs. And an informed trader, one who's willing to look beyond price and start to isolate the volume, will recognize this as an opportunity to be filled at the bid as well, giving them the chance to trade with the smart money at low risk entries rather than trying to fight to stay alive in the in the ranges of two-sided trade. Does any of this sound familiar? How many times have you been part of Group C? We've all been there. So the real question is, how can we avoid this, or at least reduce the number of times our stops turn into great trades? Well, for starters, we can learn to identify the stop trap. If we know where the traps are likely to happen, we can make adjustments to our own stops to make sure we at least lose less if we absolutely can't afford larger stops, or we can risk more to make sure we're not taken out with the rest of Group C only to find the trade coming together. Now, it might be that neither of these sound like a winning proposition to you, so how about we take it a step further? Next choice, we can learn to recognize the opportunity. With the right tools and training, we can begin to isolate the volume conditions that really create the trap. Because let's face it, stops happen all over the chart. There's always going to be winners and losers. We need a way to isolate the times when a stop run might actually pay off. This way we can not only avoid trading with Group C, but we can buy the trap levels and trade with the smart money. There's another benefit to identifying the stop run levels. Targets. Assume for the purpose of discussion that you were actually on the other side of this trade. If you'd been able to enter the market short and recognize that buyer's stop run was a potential trap, then it becomes an excellent opportunity for you to fill a limit target order, or at minimum, take profit if the level holds. So how does all this magic work?